Today, the topic of our webinar is, what is the quickest way to build your fortune? As you know, taxes are life's biggest expense. In fact, according to a recent article in Forbes magazine, they estimated that over 93% of small businesses and home-based businesses have overpaid their taxes. But today, right now, we are fortunate enough to have Mr. Sandy Botkin. Let me give you a brief introduction. Sandy Botkin is a CPA tax attorney. Sandy has been training millions of small businesses on how to get their taxes down to a legal limit for over 30 years. He also teaches tax reductions at Tony Robbins' wealth seminars and is a best-selling author of the book Lower Your Taxes Big Time and several other best-selling business books. Sandy is a frequent guest tax expert on NBC, ABC, Fox, and CNN. As a young man, Sandy worked for the IRS training their corporate tax lawyers before joining a Big Five accounting firm. After 3 years, he left the firm to start his own company. His sole passion today is to educate the small business people about the huge tax breaks available to them and do it in a fun, entertaining way. He has earned the reputation as the #1 tax expert for small business and home-based business over the North American region. So, without further ado, let's get your notebooks, pens, and smart devices out and get ready to take notes on how to write off your lifestyle and build your fortune. Oh yeah, and be sure to stay on our live Q&A where we go over steps to give yourself an instant pay raise by starting a home-based business today and reaping the benefits of adjusting your W-4 forms ASAP. Without further ado, Sandy.
Well, hello everybody, and thank you for being here today. I am so grateful to be able to share my life's work with you. I know your time is valuable, and I promise I'm not going to waste it. In fact, this is a very content-oriented program. It is also my hope that by the end of today's presentation, I can show you how you can save a couple of $1,000s on your taxes this year and every year for the rest of your life, even if we never cross paths again. Okay? So let me start jogging your memory. If you remember on the registration page for this training, you were told that in this country there are basically 2 ways to get rich as a business owner. The first is you can outmaneuver your competition, mix hard work with a little bit of luck, and make a ton of money. And the second way is to be smarter with the resources you do have. Now, I've seen many more people become wealthy with small, stable businesses than I have seen superstars strike it rich overnight. In the best-selling book, The Millionaire Next Door, the authors Stanley and Danko, which you probably heard of, found that the majority of self-made millionaires are not people who suddenly made it hugely rich, but they're people who manage their resources better. They're not people who have above-average incomes or experience superstar growth. However, that being said, if you're like most people, you're probably spending most of your time looking for the big wins and unintentionally ignoring the second strategy, which happens to be the more sure bet. Now, I'm not saying you shouldn't keep swinging for the fences. Please continue to do that, but just make sure you're not ignoring the surefire route to wealth along the way. And there's one simple thing you can do that will accelerate your wealth accumulation more than anything, and that is to lower your taxes to the legal limit. Now, that may sound strange, but here's why. You're going to spend more on taxes, believe it or not, in your life than you will spend on your food, housing, clothing, and vehicles combined. Taxes are by far your biggest life expense, and people don't realize that. Now, let's use some simple logic here. If taxes are your biggest expense, and if I can show you how to drastically reduce the amount of taxes that you are paying right now, you'd instantly have more cash in your pocket. Am I right? And if you had more cash in your pocket, you could use it any way you want. You can invest the money into growing your business. You can put it into a retirement account. You could use it to pay down your mortgage or maybe other debt. You could indulge and maybe put a little more luxury in your life and then upgrade your car or take an exotic vacation. So let me show you how drastically taxes can affect wealth building with a very interesting example. Let's pretend that you started off with $1 and that you had an investment that could double your money every year for 20 years. So your money doubles each year. Now, I know that sounds a little outrageous, but stick with me on this. And let's assume you pay no taxes, just your equity doubles each year. So every year the dollar doubles. So after year one, that $1, you now have $2. And the next year, that turns into $4 and so on. Well, if you run the numbers, at the end of 20 years, you would have just over $1 million. However, in our example, as I mentioned, we're assuming that you're not paying taxes on your earnings. So let's rerun the numbers as if you were paying taxes. In the first year, you have to pay taxes on that extra dollar of earnings. And we're going to assume a 35% rate. And when you consider federal tax, state tax, Social Security, Medicare, capital gains, 35% is not that high. So if you assume this 35% rate, then you end up with $1.65 instead of $2 because you got to pay 35 cents of that dollar in taxes. Now, let's double your $1.65. And now you pay taxes again on that gain. Now, if you take the same doubling for 20 years, but pay taxes on the earnings each year, look at this. You end up with less than $23,000. Do you see how much taxes held you back in this example? From $1 million, in fact, over $1 million versus $23,000. That is incredible. And by the way, you might wonder, why is there such a difference? The answer is you're losing the interest on all the money you're paying in taxes. That's the reason. So overpaying your taxes is definitely holding you back big time. In fact, I have a book on this. It's called Lower Your Taxes Big Time, which I recommend to everybody. And I can promise you, almost all of you are overpaying. In fact, let me tell you a quick story about my own parents. My parents were antique dealers. In fact, you see here a little picture of them. They worked hard at their business, and they did okay. But they never made it big. Well, when I was working at the IRS, my parents asked me if I would look over their tax return. And of course, like a good son, I agreed. My parents were pretty smart. They believed in hiring professionals to help them in their taxes. We're no exception, by the way. And they had somebody review their tax return. And they hired one of the more notable CPAs in the area for years. But upon reviewing the tax return, I found some missed opportunities. And we filed amended tax returns to get them back an extra $12,000 that year. And they used that money to take their first vacation in years. That meant the world to me, especially because, frankly, a short time later, my mother passed away from cancer. But that $12,000 made a difference. Now imagine how much more it would have helped them if they could have been saving them $5,000 to $10,000 each year for the last 20 years. It would have made a huge difference in their life. Let me tell you another story. This is something we did recently. Jake, my partner, set me up for a little stunt. He invited 7 self-employed people. By the way, you see here 8 because somebody brought their wife. And I never met these people. They brought their tax returns to our office for a similar experience. But the difference this time was that he only gave me 10 minutes to look at their tax return and a 1-page questionnaire. Let's see, we had a real estate agent, we had an optometrist, a network marketer, there was an owner of a landscaping company, there was an employment specialist, like a headhunter type guy, and somebody who specialized in e-commerce. The goal was to see if we could find at least $10,000 in missed tax savings for each of these people. And guess what? We did it. Not because I'm a genius, but because I knew what questions to ask. And because I knew that there's a gap between what most people perceive is happening on their taxes and what the reality is, it was really fun to see the mix of emotions on their faces. At first, they were shocked and a little upset. But then they were very grateful because they could see a way forward. And by the way, we filmed it and turned it into a little training video, which I'll show you how to get access to at the end of today's presentation. Okay? Now, I told you these stories to make a point. Most seasoned business owners don't realize that they are overpaying their taxes. I see it over and over. The former head of the American Institute of CPAs, John Potter, said the exact same thing. And if you are getting started in business, then you're almost guaranteed to be missing out. In fact, one article I read recently on Forbes.com estimated that 93% of self-employed people are overpaying their taxes. I hope everybody's listening to this. And just like the 7 strangers I talked about, they're overpaying by thousands, and in many cases, tens of thousands of dollars each and every year. Now, to make things even worse, most of the time, self-employed people are not doing what they need to do to stay compliant with the IRS or with Canada Revenue Agency. So not only are they overpaying the taxes, but they're also at risk of losing the deductions that they're currently taking, because if they were to get audited, they don't have the right records. You know, recently we were meeting with a superstar CPA named Ryan. His firm did something like, I think it was 12,000 tax returns for self-employed people last year. His phone kept ringing, and he was getting a little annoyed. Finally, he apologized and told us that the caller was one of his clients who was being audited and wanted him to represent him on the audit. Well, Ryan asked the guy to send him all the information that backed up the expenses he claimed on the tax return. And the guy admitted he didn't have any receipts or mileage records to back up his numbers. So finally, Ryan gave him the harsh truth and told him, I can't defend you if you don't have records to prove anything. Ouch. You know, I hate to say it, but most self-employed people would probably find themselves in a similar situation in an audit. They may not be doing anything illegal, but if you don't stay compliant by keeping good records, then you could get nailed. By the way, incidentally, this lack of records is why IRS wins 88% of its audits. They won 88% last year, in fact. That's almost all of them. And this is because people think or assume that because they have an accounting program or that they have a bank statement to back them up, that they're compliant. As you'll see in a little bit, they couldn't be more wrong. You know, also it's important to address compliance because as a self-employed person, you are as much as a 700% more likely to be audited than someone who is an employee. I'd like that to sink in. But good news is, don't worry. On this webinar, we're going to show you how we've saved our clients over $1 billion, that's with a B, folks, in taxes in just the last few years alone, while at the same time helping them automate their compliance so that they're doing things correctly with the full backing and support of both IRS and Canada Revenue Agency. Imagine that. Increased deductions, reduced chance of audit. I know that sounds strange, but that's exactly what we're going to accomplish. Okay, first let's talk about how to profit from the new tax laws, because that's very important. First, you need to understand that we have 2 tax systems in both the U.S. and Canada. Most people think I'm going to say one is for rich and the one for poor, but that's really one to make you rich. And then there's one that limits your chances. So one is for employees, and the other is for self-employed people or business owners. Now, business owners get significantly better tax deductions. That's particularly true under the new tax law. These deductions allow you to keep more of your money so you can invest it and grow the business. They create cash that you never have to pay back, and sometimes they create the cash seemingly out of thin air. So let me show you an example. Let's look at a quick example here with Mary. I want you to meet my friend Mary, by the way. Mary has the following life expenses. She has a cell phone bill, which is not deductible as an employee. She pays a mortgage or rent, which is generally not deductible. She has a car expense like gas and maintenance, which is not deductible as an employee. She eats out with friends at restaurants, which is not deductible. She has medical expenses for her family. And if she works for someone else and has a job, then she doesn't get any notable deductions, as I mentioned. However, if Mary starts her own business, portions of these exact same expenses that I remind you she was already paying for now become partially deductible. For this particular case study, she still had the same expenses, but she was able to get back $3,600 more on her tax refund than she did as an employee. And this is the reason I tell people that if you don't have some kind of business, then you are brain dead. And that's actually my first chapter in my book, Lower Your Taxes Big Time. The government actually wants you to be in business. And if you're willing to put in the time and energy to make a business profitable, then they will support you and allow you to take deductions, which make it possible for you to keep more of your money to invest and to grow your business. Does that make sense, everybody? Okay, and this is just, by the way, a teeny tiny bit of tax deductions that she or you could qualify for. It's the tip of the proverbial tip of the iceberg, so to speak. Okay? Now, a word of caution. Because the tax laws for business are so much better than the ones for individual, the government wants to make sure people don't abuse it. So, the IRS spends a lot more money on auditing business. You are as much as 700% more likely to be audited than that an employee. But don't let that worry you, because today we're going to share with you how easy it is to stay compliant. Now let's dive in and let me share 5, I think, really solid tax deductions you should know about. And I stress that you should know about them. Don't just rely on your accountant, because if you understand them, then you can maximize the savings and your accountant will file it for you. Okay, now this is the real meat and potatoes of the presentation, so make sure that you have some pen and paper ready to write down some notes. We have a lot of good content to cover. As I mentioned, this is a very content-rich program. Now, one of the most profitable deductions for business owners, frankly, is their vehicle. You know, today I'm going to show you how this deduction could save you literally hundreds of thousands of dollars on your taxes in your lifetime. Even if you don't drive that much, if you work from home, this could still be a huge win for you. Now, what I'm about to share with you will work for you whether you buy a new car for your business or you just drive your personal car or get a used car for your business errands. Basically, there are 2 ways to deduct a car. The first way is called the standard mileage rate, and the second method is the actual expense method. And I'm going to go over both. The first one, which is the standard mileage rate, if you're from Canada, by the way, let me mention you Canadians cannot use this, okay? You can use this in the U.S., but you can't do it in Canada. And I'm going to show you what method you can use in Canada. Now, in the United States, the government gives you 58 cents a mile for every mile you drive for business. And by the way, who determines how many miles you drive for business? Does the government or do we? And the answer is we do. And how do we do it? From our tax tracker or tax organizer. And I'm going to get into that. So let me give you an example. Let's say that your car gets 20 miles per gallon. And at 20 miles times 58 cents, that gives you $11.60 in deductions. And let's assume that you're in the 33% tax bracket. So you would multiply your tax bracket by the cash savings. That tells you how much cash this is worth. In this case, that is worth $3.82. That's a physical cash savings in your pocket. So if gas costs you roughly $2.25 a gallon, and you get to save $3.59 in cash savings by getting this deduction, you're getting paid to drive your car for business. Does everybody see that? All right, now for the actual method. In this method, you first figure out what percentage of your driving was business driving. Then you add up all your expenses, such as gas, oil, insurance, wash, wax, repairs, depreciation, and so on. And you multiply it by your business usage, which is basically how much you use that car, the percentage you use that car for business. So let's take an example. Let's say that you drove your car 40,000 miles in a particular given year, and you logged half of that mileage for business purposes, then 50% of all your expenses are considered for business. So if you assume that you had $11,000 in vehicle expenses, you would get to deduct half of that, or $5,500. That's how that works. Now here is the dirty little secret from the IRS. Vehicle deductions are the #1 audited expense by the IRS. This is true of Canada, by the way. And that's because almost all of you are probably doing it wrong. So it's an easy target when auditing a business. And here's what the IRS and Canada Revenue Agency requires you to have. First of all, you have to have an annual log showing the beginning and ending odometer mileage for the year. Secondly, you need a mileage journal that includes the following: the date of each trip, the address or odometer reading of each trip, number 3, the total mileage for each trip, and finally, the one that almost everyone does incorrectly, a specific explanation of the business purpose for each trip. Now let's do an example. You can see on screen that I have the date the mileage, and the address. Now let's look at a specific business purpose. Specific, and I'm emphasizing the word specific here, is an example of a specific reason. For example, met with John Smith from Apple Orchard to ask for referrals. Now here's an example of a non-specific reason. Sales call. Prospect. That is non-specific. If you don't have a specific purpose, then the IRS can disallow your mileage. This is your alibi. You know, you watch criminal shows on television. When a police ask what you did to make sure you're a victim or whether you really committed the crime or you didn't commit the crime, what's the first thing they want? Your alibi. They want to know you have proof that you weren't there, that you were somewhere else. And what's a better alibi? That I was at the 9/10 showing of some of the latest movie at the Rio, or I just went to the movies? Obviously, the more specific, the better. So if you don't have a specific purpose, then both IRS and Canada Revenue Agency can disallow your mileage. It is very important to recognize that a lot of mileage logs out in the market today don't focus on getting specific purpose for that trip. It is very unfortunate. They give you a generic list at best to pick from, such as client meeting or sales call. I hate to tell you, that's not going to cut it with the IRS or Canada Revenue Agency, and those people are going to learn the hard way. Make sure that you are noting the specific reason in order to stay compliant. I can't say that enough. This is very important to do right. Now, in fact, there was a very famous case of a guy who found out that he was going to be audited for his vehicle deductions. And the IRS asked him to produce a mileage log, which he didn't have. So he painstakingly brought some notebooks, and basically what he did is beat them up to make them look old and used. He put some coffee stains on some right spots. He meticulously tried to write down and recreate as many trips as he could. He did a pretty good job of it too, by the way. I think the best forgers in the world would probably be proud. But it turns out his notebooks were inscribed with the date that they were printed. He used a 1996 notebook for 1994 expenses, which was well after the time when the trip should have been logged. So the IRS threw out all his vehicle expenses. This is something you want to get right. So the IRS will look deeply at this, and the same thing is true with Canada Revenue Agency if you're Canadians. Now, we've been talking about deducting the cost of operating your vehicle. Let's talk about deducting the purchase price of one. This is a tip that could probably save you a lot of money, even if you don't drive that much. You know, a lot of savvy business owners buy certain types of vehicles, namely trucks, large SUVs, and vans. And the reason is simple. In the United States, you can deduct up to 100% of the purchase price in a single year if you do it right. It's not true in Canada, but it is true in the United States. Now, I say up to because it depends on how much you drive for business that year. By the way, I want to emphasize, you get this deduction even if you finance it. Jake, my partner, did this last year. He bought a new Dodge Ram pickup for about $40,000. Now, he didn't pay cash for the truck. He got a car payment. So he might be paying, let's say, $500 a month or so. But he got to write off almost all of the $40,000 last year based on his business usage. Not a bad deal. I think he drove his truck something like 85% for business that year and wrote off 85% of the $40,000 price tag. So how did he prove that he qualified to write off 85% of that? The answer? He kept a detailed mileage log that was compliant. That is the key. You know, a lot of times people ask me, will IRS really believe everything you say in your tax tracker or your notebook? Yeah, they will. They have to by law. Now, by the way, here's a hot tip for getting more business mileage. Normally, personal trips aren't deductible. So let's say you take your kids to tutoring. That's not deductible. If you go to your mom's house, that's normally not deductible. You go to a doctor, not deductible. So you ask yourself, do you have a client or a prospect or maybe an opportunity meeting somewhere near where your personal trip is? In this case, visiting your mom, let's say. If so, a substantial part of that trip could become deductible. The key is documentation of the business that you did. Nothing else on the trip matters to the government. This trick will help you turn more of your trips into deductible ones. All right, now let's talk about something fun. Eating. I like eating. In both the U.S. and Canada, you are allowed to deduct 50% of your meals for anyone who is a potential prospect or can in some way increase your business. So my question to you is very simple. Who are the potential users of your product or prospects for your business? who could potentially give you a referral. If you think about it hard enough, almost everyone could help you grow your business, which means that almost everyone could create a meal deduction for you. And if you're eating lunch with someone and paying for part of that bill and you're not writing it off, you're leaving money on the table. So here's what you need to do to qualify. Simply tell them, your prospect or your client, in advance that you're going to talk to them about business at lunch. Then simply talk business. And finally, document it correctly in a good tax tracker and write it off. That's it. All these steps, all 4 steps are important. You can't just show up to a restaurant, talk shop with the waiter, and write it off. It won't work. It has to be pre-scheduled. Oh, and I almost forgot. You don't even have to pay for their meal. If you went to lunch with a friend and you each paid your own way, you could still deduct this if you met the other requirements. You call that a Dutch Street meal. Now, when it comes to meals, the IRS asks you to prove that your meals qualify for the deduction. So, how do you prove it? The answer? By writing down or recording what I call the 5 W's and an H in a good tax tracker or tax organizer. The IRS, and this is true for Canada too, wants a written log of who. That's W number 1. Who did you meet with? What type of expense was it? Breakfast, lunch, dinner, snack, what was it? Why? That's a 3rd W. Why should it be considered a business? Again, you need to be super specific here. Next W, where? Where did you eat? I went at home. I went at Outback Steakhouse or Greasy Lloyd's or Tim Hortons. And the final W, when did you eat there? What was the date? And finally, how much? How much was it? 5 W's and an H. Now, I want you to notice something that's very important here. Only some of this information would be found on a bank statement or in your accounting system. And this is important because people think that their credit card statement would back them up, but your statement doesn't have who you met with, and it certainly doesn't have a specific description of why it was business. You must have a written record of this type of information. Now, since we're talking about expenses, let's quickly address the topic of receipts. Do you need them or not? Well, in Canada, the answer is yes. In the United States, there are a few instances where you don't actually need a receipt. But I strongly recommend that you keep receipts for everything. But, it's an old saying, pack rats pay less tax, and you're going to find that's to be the case. But if you're curious, here's the receipt rule for those of you who are very curious. For travel and entertainment expenses, this is true for meal expenses, for example, less than $75, you don't need a receipt, as long as you have the 5 W's and an H written down in a tax tracker or tax organizer. But for almost everything else, you must have a receipt. So if you go to Staples for $10 in office supplies, do you need a receipt? Yes. So here is my advice. I would still get a receipt for all of it, even if you don't need it, because IRS auditors just love to see these things. Same thing is true in Canada. If they say it, they don't have good records, then it's easy to nail you. But I just tell you this rule so you know it. I once went out to lunch with a client, and the restaurant's printer wasn't working, so I couldn't get the receipt. And so in that instance, I didn't sweat it, because it was less than $75. That's the key. But I still need to document the 5 W's and an H in my tax tracker or organizer to stay compliant. In truth, I really don't like teaching people about the $75 rule because, frankly, they forget that it's only for meals and travel, and they forget to write down the details. And then they stop getting receipts for things they really need them for. So keep them for everything is a good rule of thumb, to be honest with you. Now, back to the 5 W's and an H, where you should write them. Where should you write them down? Where should you keep the receipts? You could keep a manual file for them, but that requires a lot of work. Not to mention the fact, if your house gets flooded or you have a hurricane, you then lose them. Now, I'm not going to talk about it right at this moment, but here's my sort of shameless plug for our company. This is exactly why we built our mobile application, Taxbot. And we can show you how it works briefly when we are done with today's presentation. But basically, Taxbot automates your mileage and your expense and receipt management. Anyway, more on that later. Now let's talk about a second deduction, major deduction, and that's the home office. You've probably heard about claiming a home office. It's not going to is going to trigger an audit, and it's not worth it. I bet you heard that. Well, I'm here to tell you that in 1999, Congress liberalized the home office rules for Americans. Canadians did a similar thing too, by the way. Now, I want you to ask yourself, why would both governments do this if they didn't want home office deductions used? You know, absolutely they wouldn't do it otherwise. So it's not a red flag for an audit. If you qualify for a home office deduction and you don't take advantage of this, you are crazy, and I'm here to tell you that. So let's go over this deduction in a little bit more detail. So let's give you an example of how the home office deduction works. Let's say that you have a house that you own or are renting, and you have a bedroom that you use for your home office. We'll assume one of your bedrooms is an office. And we'll also assume that that your office represents about 1/8 of the total square footage of your home. There's nothing magical about 1/8, by the way. I'm just taking this as an example. But what does this mean? This means that 1/8 of your home is used for business, which means that 1/8 of your expenses associated with your home become deductible. So that means that 1/8 of the utilities become deductible. Normally, without a home office, you can't deduct the utilities. But by claiming a home office, you can. 1/8 of the interest on your home now becomes business interest. It becomes a deduction. And by the way, for you Canadians who can't deduct interest on homes, this is a way you can get a partial deduction for your interest. 1/8 of the property taxes becomes deductible. 1/8 of the house can be depreciated, although in Canada I don't recommend that, otherwise you have to pay tax on that. 1/8 of, if you're paying rent, you can also claim a home office because 1/8 of the rent will be deductible in this example. 1/8 of the maid service, of the alarm service, the repairs, the insurance, the snow removal, the lawn care. The stuff really adds up. In fact, I ran the numbers, and on an average home with an average expenses, we found that a home office would be worth about $15,000 to you every 5 years. This is not chump change, folks. That's every 5 years. Not just an average home. Now, there are, of course, some qualifications that you have to meet. The office has to be used an exclusive portion for business, for example. In order to claim a home office, you must have a separate identifiable area of your home that you use only for business purpose. And I'm very serious about this. It doesn't have to be a whole room. It can be part of a room, but it must stay separate. Also, there can be no personal items in the exclusive area you've designed, other than incidental stuff, like maybe a radio for music. If you have a bookshelf, you shouldn't have any cookbooks or fantasy novels in that area. If you have a desktop computer in the office, you can't let your kids play games on that, computer games, or do their homework there. So here's the problem. How do you prove that the area is exclusive and separate? I mean, let's face it. You claim a home office today, you don't get audited for another 2 years. I suggest you take a photo of your area every single year, and you keep it for evidence in case of an audit. I bet your accountant never told you that one. I get asked all the time if an IRS agent or a Canada Revenue agent would really show up and want to look through my bookshelf. And the answer is yes, they will. However, they will give you a bit of notice first. Now, I'm not saying you should take advantage of this fact, but they will at least give you some notice when they're coming. Now, you've also got to use it roughly 4 to 5 days a week for at least 45 minutes per day. It also has to be your principal place of business. Now, you basically don't have another office for your administrative work. And you use this office for the majority of your business management. So that's the key. Your home has to be the majority of your business management, and that's where you do your administrative work. Okay? That's basically the bottom line. Now, not only can you deduct the real estate portion of your home business, but you can also deduct and depreciate the furniture and equipment in your home that you use for business. And these include things like desks, chairs, computers, printers, cell phones. And by that I mean the actual device. Your filing cabinet, desk organizer, rugs, lamps, bookshelves, whiteboards, decorations. The IRS makes use of depreciation to deduct equipment. So let me explain how this works. Let's take a $1,200 desk as an example, okay? Furniture like desks are depreciated over 7 years. So in the United States, you would take roughly $1,200, divide by that 7-year life, or give you $172 a year of deductions. That's the 172 is how much you could deduct each year for depreciation for 7 years. Now, 172 is at least something, but let me tell you about an even better way, and that is by using Section 179 of the Internal Revenue Code. It's called the Section 179 deduction. Very creative. If your desk is new to you, and doesn't have to be new, just new to you, the Section 179 deduction actually allows you to depreciate the entire thing in the first year, not over 7 years, but in the first year. Now, that's much better, isn't it? All right, here's another awesome tip. Here's a third deduction. How would you like to deduct the equivalent of your kid's college education and even their wedding? And I'm not kidding when I'm saying this. I'm going to show you how you can do that. How do you do it? Well, college tuition is not deductible. But if you hire your kids to work in your business, are wages you pay an assistant deductible? Yes. You know, seriously, if you own your business, there are things your kids can do for you. Some examples might include things like filing paperwork, cleaning the office, licking envelopes, dropping off flyers or brochures, managing your social media, emailing clients, answering phones. You know, if you were to put an advertisement online on a newspaper and hire an employee, wouldn't that be a deductible expense? Well, it's the same thing. Most of us parents just pay out of pocket for all our kids' expenses. But if you use this strategy, your kid can be paid a reasonable wage and pay for these things themselves. This way you get to deduct the payment as wages. It's the same money. Only in this case, you get to deduct the cost. Just pay them a reasonable wage and keep track of their hours. Not only can you deduct the wages, but with new tax reform, the first $12,200 is tax-free. So if your child earns less than $12,200, they don't have to pay any taxes because they get a standard deduction on their own tax return of $12,200. In Canada, it's even higher, by the way. If you pay them more than $12,200 in a given year, then you must pay unemployment tax and federal and state income tax as well. Now, let me give you a quick personal example of how I use this deduction. My daughter was in college, majoring in digital design. I decided I wanted to build a new website for my business, and I had a professional web design firm quote me doing the work, and I wanted a lot of bells and whistles, not one of these free garbage sites. Their bid at the time came in at about $40,000. I mean, now it would be a little bit cheaper, but at that time it was about $40,000. So I approached my daughter, who definitely had the skill set to build my website, which, by the way, is an important factor in justifying the hire. And I asked her if she could build it for slightly less than what the professional design firm wanted, and she agreed. I paid her enough money to cover roughly 2 years' worth of tuition and room and board. I saved more than $15,000 in taxes by hiring my daughter rather than paying her education outright. Next, that's the fourth major deduction. I want to talk about medical expenses. You know, if you're self-employed, you can fully deduct your health insurance premiums. However, you have to follow a few rules. Rule 1, if your provider pays for part of the health insurance coverage, then you don't get an immediate deduction. It has to exceed 10% of your adjusted gross earnings, but anything beyond that can be written off. However, that's a high threshold that most people won't meet. The second test is that deducting your premiums cannot create a loss in your business. So you can't have your employer subsidize your premiums, otherwise it has to exceed 10% of your adjusted gross earnings, and 2, it can't create a loss. So that covers your insurance premiums. But what about other medical expenses, dental, deductibles, eyeglasses, things like that? Unfortunately, medical expenses are not automatically deductible on their own. In order to qualify, they need to be greater than normally 10% of your adjusted gross earnings. The expense must be treated as a medical condition or illness. It could even be an over-the-counter drug as long as they qualify with a doctor's prescription. But is there a better way than having to exceed 10% of your adjusted gross? Yes, the smart, savvy business owners are doing something different. And I'm going to tell you about 2 of what they're doing right now, 2 strategies. The first one is called a health savings account, otherwise known as HSA, or health reimbursement account, HRA. Many of these things now become deductible. This will significantly improve your savings, let's be honest, because there's no threshold. You're not deducting this as a medical expense, you're deducting this as a business expense. Now, a lot of you may have heard of an HSA before, and they're very nice. An HSA is like a special bank account that you can deposit money into tax-free and then use to pay for medical expenses that are not covered by insurance. It can be used to pay for deductibles, co-insurance, braces for your kids, etc. Now, you must have a high deductible plan, however, and there are limits as to how much you can contribute, which change each year. For 2019, for example, the minimum deductible you have per person is $1,350, or $2,700 if you happen to have a family. HSAs also have a maximum contribution yearly limit. For 2019, that's $3,500 for a single person and $7,000 for a family. Now, we're not going to go over this too much detail about this, but you should talk with your financial planner or your financial institution to evaluate your options about this. It's called an HSA. Now, let me tell you about my favorite strategy when it comes to medical deductions, and it's often much better than an HSA, and this is called a health reimbursement account, otherwise known as HRA, Health Reimbursement Arrangement. Now, I got to tell you, it is worth its weight in gold. And let me explain how it works. There's a rule that allows business to put in place a plan that reimburses employees for all medical expenses that they have that are not covered by insurance. Now, you don't hear very much about this in corporate America. Why? Because Fortune 500 companies, frankly, can't afford to pay for all their employees' out-of-pocket medical expenses. It becomes just prohibitively expensive. They can barely afford to pay for health insurance as it is. But this is where it works great for small business owners. Usually how this works is that you hire your spouse for your business, do something that you could be done part-time in your business. It doesn't have to be that much. It could be like filing paperwork, for example. It could be bookkeeping. It could be for delivering products. Now, if your spouse is already involved in your business, they don't really have to change anything. All you need to do is to get an approved plan in place. Now, with your spouse as a legitimate employee of your business, you can offer to reimburse them for out-of-pocket medical expenses for them and for family members. So, as I said, you can now cover the family, which includes you. So effectively, you're hiring your spouse is electing family coverage, which means they're covering you and the kids, and you're getting a full deduction for all those things. Not as a medical expense, but as a tax-free business expense. Is that cool or what? And it's blessed by the IRS and Canada. Now, with an HRA, health reimbursement account, you can reimburse almost anything medically related. You are no longer limited to your health insurance premiums. Having to have a prescription or even have a high threshold, we talked about. All of that you've avoided. With this plan, you can now deduct things like braces, acupuncture, laboratory fees, laser eye surgery, contact lenses, unreimbursed expenses by the government, and so on. The sky is almost the limit here. It's absolutely amazing. Now, a little work needs to go in order to set up an HRA. And even when it gets set up, you need to make sure you follow the rules. These requirements have been made into a pain in the past. It was still worth doing, but it was a pain. In fact, we used to recommend this strategy to our clients, but we knew that they would need to work a bit harder to administer it completely and correctly. So here's the good news. In the past 6 to 7 years, that has all changed. We were introduced to a company called TASC, that can set up and manage all of it for you at a very reasonable price. In fact, I personally use them for my own HRA, and so does my partners at Taxbot. If you're interested in learning more, please go to hra.taxbot.com. That's hra.taxbot.com. We set up a short quiz that you can take to see if the HRA makes sense in your situation. You can also contact our customer service department or send us a chat or email, and we can get you this information, okay? So that's hra.taxbot.com. Okay, let's pause to recap what we've learned so far. We've shown you that lowering your taxes is one of the quickest way to build your wealth because it's life's biggest expense. My guess is that if you implement just a few strategies we taught today, you could easily save anywhere between a couple thousand to tens of thousands of dollars in your taxes. I've seen it happen over and over. We also talked a lot about compliance because our goal, frankly, is to save you money on taxes, but also we want to do it with the full support of IRS and Canada Revenue Agency. You know, as we discussed earlier, you don't have to be scared of the IRS or Canada if you keep good records. We talked about how credit card statements are not good enough because the IRS, and so does Canada Revenue Agency, wants receipts for almost everything. And they both need details about who you met with and what you talked about for certain expenses like meals. Now, in reality, most accounting software is also not good enough. Accounting software was designed to keep track of money. It wasn't designed for tax compliance in mind, as I mentioned. Have you ever been asked by your accounting software, for example, to include who you met with, or to enter a description of your meeting, or what your next year is going to be like? No way, because that isn't what they do. It's accounting software, not compliance software. And they'll be the first to tell you that. It's actually a shame, because in an audit, you are treated as if you are guilty until you prove your innocence. That's a very important point that you need to realize. Or in other words, until you produce backup for your financials, things like mileage logs and receipts, if you don't produce those, you're guilty. Period. Now, keeping good records in the past has been very tedious. You had to have a clipboard in your car so you can painstakingly write down your mileage. Then you had to have a journal or an appointment book dedicated to writing down every expense. Not to mention, you would need to keep copies of receipts and keep them organized so you can find a receipt easily. Good luck on that one. Raise your hands if you ever used the proverbial shortcut method, stuffing receipts into an old shoebox or a folder, okay? I'm guessing most of you have done some of this before. I know I used to do that years ago. And even if you were lucky enough to get every receipt into the shoebox, you would then have to hope that the receipts didn't fade or get ripped or get destroyed in a hurricane or fire. And you still need to spend time organizing them and transposing the amounts and reasons for each expense. That's my version of hell, to be honest with you. It was for these reasons that we decided to start our company, Taxbot, to automate all the compliance and to keep you out of trouble with both the IRS and the Canada Revenue Agency. And it literally costs pennies a day, and I'm not exaggerating. But rather than listen to me explain it, I thought I would try something kind of different today. We recently put together a pretty funny video. It's a video that shows exactly how Taxbot works. So let me press play here, and then I'll come back on after to wrap up, and then we'll get to see some of your questions, okay?
Running a business is a lot like running a circus. Some of your jobs are glamorous, and others are kind of crappy. But you're the boss. You get to make all the important decisions. Like the ones to make robots do all those crappy jobs for you. Like the poop scooping. Do you know what's worse than shoveling turds? Bookkeeping. But there's a robot that can automate that for you too. It's an app called Taxbot, and it automatically keeps track of all your business tax deductions and keeps you out of trouble with the IRS. Take mileage tracking. Taxbot tracks your trips using the same technology you find in your fitness app. When you start driving, Taxbot starts tracking. You don't even have to push a button, so you can start thinking of more important things like where to go for lunch, or perhaps work on your next profile pic. Perfect. And later, when you open Taxbot, all the hard work has been done, and everything is delivered to you like a delicious dessert on a silver platter. That tastes just like a tax refund. And unlike the competition, Taxbot makes it easy for you to identify your previous trips. Let's compare, shall we? This one gives you 2 points on 2 maps. It's like the worst map ever. And let's look at the addresses. Well, congratulations! You went from LA to LA. Real helpful, fellas. Taxbot gives you 1 map with the actual route you drove. Plus, you get the full addresses. And since the IRS likes you to have legitimate reasons for business travel, Taxbot matches the trips with the meetings on your calendar, so it's easy to prove you took the trip for legitimate business reasons. So, which one of these makes it easier for you to identify your mileage? Well, it doesn't take a genius IQ to answer that question. As for all those pesky business receipts that have been piling up, well, it's as simple as a selfie. With Taxbot, your only job is to snap pictures of your receipts. Once you take a picture, Taxbot takes over. It smart matches each receipt to a transaction on your credit card or bank statement. It can even match receipts that go to your email inbox. And once again, it uses patent-pending technology to pull information from your calendar, so you don't have to type. And all you have to do is approve the work that Taxbot has already done. And unlike other apps that just keep track of your deductions, Taxbot actually helps keep you out of trouble with Uncle Sam. Which is important, because last year, the IRS won 9 out of 10 audits. That's like almost all of them. Taxbot gives you an audit-safe report with manage in one place. It's like magic. Plus, if you sign up for a 14-day free trial of Taxbot today, you'll also receive a can of auditor repellent. Just kidding. But if you ever are audited, you'll be prepared, just like this happy Taxbot user.
The audit was completed, and the IRS left my house within the hour. No change occurred.
So, if you'd like to fire yourself from your crappy bookkeeping job, click now and start your 14-day free trial of Taxbot today. If you're still not convinced, take a look at what other people are saying. Taxbot has saved users over $1 billion in taxes and has a 4.8-star review in the App Store. It's been recommended by all kinds of important folks, accounting associations, real estate associations, and circus owners everywhere. Listen, people always ask me why I choose to run a circus. Truth is, I love being my own boss. I love my work and the satisfaction it brings me. But seriously, some parts of running a business are crappy. So do what I did. Automate those crappy jobs, or at least automate your bookkeeping.
It's kind of a fun presentation, isn't it? Am I right? I do have a couple of quick notes. Our average user uses Taxbot app about 12 minutes a month. That's the average. And logs on more than $10,000 in tax savings each year. And it's 100% IRS and Canada Revenue Agent compliant if you follow the rules. How does that feel? Not bad, especially since the price of Taxbot is only $100 per year. Anyway, I have a couple of options for you if you're interested in trying out Taxbot, which I think you probably should be. Now, based on some agreements that we have with the distribution partners like Apple and Google, the price on our website is fixed at $100, so we really can't sell it for less than that. But this doesn't stop us from being able to sweeten the pot as much as we want. So I've put some awesome bonuses together for those that attend the webinar. It's not available if you get everything just through the Apple Store or the Droid Store. I can't keep the bonuses open to the public, though, so some of these are only good for the next 24 hours after you attend this webinar. The first bonus is to double the length of our 14-day trial period. On the Apple side, it's 14 days. Here we're doubling it. Not only are we giving you a 30-day trial, but we're offering a 30-day money-back guarantee. Neither of these are available if you just download it from the App Store. The next three bonuses are new. We've never offered them before. The second bonus is I'm going to give you is an extra 3 months on top of the annual for free. So after a trial period, you're going to get 15 months for the price of 12. That's another benefit. Bonus number 3. I'm going to include our Taxbot Audit Safe Guarantee as part of the deal. You're going to like this. This is a cool new product that we're offering on a limited basis. And here's what it means. If you get audited by the IRS or Canada Revenue Agency, and you have consistently used the Taxbot application to track your expenses, mileage, and receipts as it was designed, Taxbot will help pay for your audit defense up to $1,000. We are that confident in Taxbot and what it can do for you. Pretty cool, right? Bonus number 4 gets you access to our Taxbot Certified Professional Network. Let me quickly explain what this network is. Over the years, we've done surveys, and we found that 80% of the people wish they had an accountant that was more proactive or that understood their situation better. So, we've been putting together a network of tax preparers that have been through our certification process. They understand the world of small business clients and are committed to help them throughout the year. Our Taxbot certified partners love our Taxbot customers because when you have organized records, your accountant can do so much more for you. They will have more time to put together a strategy to keep more of your hard-earned money. So you'll get access to our Taxbot certified professional network. And we're very excited about this. Now, if you're not interested in Taxbot, but you'd like to learn more about how to make sure you get all the deductions you're entitled to, then I have a special offer for you as well. It is our Taxbot University program. This program is a short online course taught by me. In my opinion, I'm being biased here, it is the most informative training I've ever done. I've been doing this now for over 30 years. This is the best I've ever done. It is a course I will show you all the tips and tricks I've learned over the years to save you a ton of money. Now, a quick word of warning. 80% of the people who finish the course get depressed. Really. They are depressed because they finally realize how much they have been fixing a problem is realizing you have one. You'll see a bunch of missed opportunities that you could have been using, and you'll be tempted to build a spreadsheet to estimate how much money you could have lost. Don't do it, bro. You know, I have a saying. In order to create a future, you can't be focused in the past. Just focus forward. Because the good news is that the course teaches you how to fix it. It teaches you how to plug the tax leaks in your business. I got to tell you, my students have had tremendous success. You know, a while ago, I surveyed my students 1 year after they've been through the course at the end of tax season. To my delight, and to theirs too, actually, the average student in the class claimed an additional, get this, over $20,000 in new deductions. This means they saved an additional $8,000 to $10,000 the very next year because of this class. And this was not new money. This is money they're already spending, things that their accountant never told them. Now, normally tuition to enroll in the course is $395, and it's worth every penny of that. You're going to get over $20,000 in deductions. Because it's my life's work, and because I made it so clear and easy. But right now, you can pick up Taxbot University for a one-time tuition cost of only $199. It also comes with a guarantee. Simply finish the course within the first 60 days. And if you don't feel like you saved at least 10 times that much money on your taxes, so we're guaranteeing 1,000% rate of return, not bad, huh? The very next year, okay? Then simply call for a full refund. There's no hassle, no haggling. I hope you'll be satisfied, though, when you see how much money you're going to really save. Really, this is one of my favorite things, to see people's eyes light up when they see the dollar signs, I'll tell you that. You know, today, we're also including a free one-year membership in our Inner Circle. Now, what does that mean? What does that mean to be in the Inner Circle? Well, once per quarter, members of the Inner Circle get to submit their tax questions to me. Then, I get a group video call, and I answer their questions and share insights. It's a very helpful program, and we normally charge $200 for a year for it. But when you sign up today, I'll give you the first year for free. Then after a year, if you like it, you can sign up for it. Now, if you want to grab both Taxbot and Taxbot University so you can increase your tax savings and automate your compliance to keep the IRS off your back, then you can bundle them together for an even bigger deal. If you decide to bundle them together with Taxbot University and Taxbot, you'll get the following. 1, you'll get the Taxbot application to help you stay compliant and automate your compliance. 2, you'll get 3 extra months added, so that you'll get 15 months for the price of 12 for your first year. 3, you get our Audit Safe Defense Guarantee, which will help cover you in an audit if you are using Taxbot regularly. 4, you get access to our Taxbot Certified Professional Network to find a certified CPA to help you do your taxes. 5, you'll get our Taxbot University Education Program, which, by the way, gets updated, and you get access to it for as long as you live. It's a one-time charge, and you get access to it for life with our university program. 6, 1-year access to our Inner Circle program, which has a total value of $850. But if you are ready to go within the next 24 hours, you can get it for only $249. And it's not even $249. Why not? Because it's tax deductible. So it's roughly $180 after taxes. What's that, about 60 cents a day? You know, as I mentioned earlier, because of the distribution agreement with folks like Google and Apple, we are required to keep our pricing offered to the general public consistent to what can be found in their store. So we can't keep this open to the public forever. To keep us compliant, we use some software that disables this offer 24 hours from the time you attend the webinar. So if you're interested in the bundle, I suggest you go for it. Now remember that we have guarantees on everything. So give Taxbot and Taxbot University a try. And if you don't like them, hey, get your money back and keep the bonuses. Now, if you're interested, click on the link on the screen and we'll take you to a secure order form where you can get going. I truly believe that this is the best way for you to build wealth legally and ethically by profiting from the tax laws we have in this country. And do it in a way that IRS and Canada Revenue Agents wants you done, so you can have total confidence that you would win in an audit. So even if you decide not to use our products, please do something to start tracking your expenses and mileage in a way that will protect you.
All right, well, Mr. Botkin, one of the key components of having a home-based business that excites people a lot is how to start making money right away, which would be adjusting your W-4s so that they would not have that, that amount come out of their check any longer. So what would be the correct way to do that, sir?
That's a really interesting question. In order to answer that question, let me give you a little background about what the law is so people can understand this. You'll understand why I'm going to give you the answer I'm going to give you. Right now, we have two, and we mentioned this in the program, we have two business systems, in a sense, two systems of taxation in this country. One is to create economic growth, which is designed for small business, and one is to take your wealth. The one where you're in business, you have a small business, that's the one to create wealth. And the reason that's created, as we mentioned, is the fact that the small business is the economic engine behind the economy. You get from little acorns, you get big trees. And that's why there are some very good tax laws for small business. However, if you're solely an employee, then you don't get a lot of the good benefits that small business people get. So let's make sure that's the first thing we need to understand.
Okay.
Now, second thing is if your business generates a loss, and sometimes businesses do generate losses, particularly when you start a business, that loss can be used against any form of income you have. Interest, dividends, wages, pensions, rents, anything. So let's take an example. Let's say you have a job that's making you $50,000 a year. Your small business happens to generate a little $10,000 loss. You only pay taxes on the net, which is $40,000. Now, in prior years, if we expected losses, we could adjust our withholding, which is what you're getting at, in order to get a smaller amount withheld to make up for those losses.
Absolutely.
And the way it worked is for every $3,600, which is equal to one exemption, you were able to adjust your withholding exemptions by one. So if you expected $3,600 of losses, you could adjust your withholding by one. If you expected $7,200 worth of losses, you could adjust your withholding by two. The problem is that you don't know whether you're going to have losses when you first start this business. That's the first problem. The second problem is there's no longer exemptions anymore. The government got rid of the exemptions under the new tax law. So and there's one more problem. If you suddenly adjust your withholding, thinking that, I'm going to have losses, you're telling the IRS, you're sort of giving them ammunition saying, hey, I may not be running my business like a business because I'm expecting losses. I'm not expecting to have a profit, which is what they want you to expect. You don't necessarily have to have a profit, but they certainly want you to try and expect to get a profit. That's the point.
Right.
So my suggestion is you do not adjust your withholding. Even though it's very tempting to do so, my suggestion is you do not adjust your withholding until you get a handle as to what your losses might be or will be during the year. At that point, you can then adjust your withholding to make up for the lower taxes that you might have to pay. But up to that point, I would not adjust your withholding.
Okay. So let me ask you this. As it relates to, if you can look back at your tax return, your tax statement from the prior year, then you can try to make those adjustments. But you most definitely would not want to do it not knowing anything. Is that correct?
That is correct. And even looking at the prior year, you have to ask yourself, will the prior year be the same as this year? And if you adjust the withholding, then you're telling IRS, not only did I have losses last year, I'm going to have losses this year. And that's something that isn't good because you might be considered a hobby and not a business. And that's something you never want to be considered. So, again, it is my suggestion that unless you're actually expecting losses this year, you do not adjust your withholding. Now, you can always do it towards the middle of the year or towards the end of the year. You can say, I've already seen, based on financials that I've done, that I'm going to have a $10,000 or $20,000 loss. At that point, you can meet with your accountant and adjust your withholding for this year. But until you have some basic information as to whether or not you can have a loss, I would not adjust the withholding.
Okay. All right. Well, that was one of the major questions because, as you kind of saw, that's exactly what motivates people to get into a home-based business, because at the end of the day, they want to start off successful. But at the same time, that's how come I provide multiple home-based business opportunities, to whereas, hey, you don't have to really start off in the hole. You know, a lot of them, and I don't really want to call out a name, but, you know, start at $500 investments, and it's a legitimate company, but you have a $500 investment, and when you have that type of, investment, people want to at least make their money back. So
well, some of that investment might be deductible or at least amortizable as a startup expense. So there are some ways they may be able to get a deduction for some of that stuff. But the key here is you don't want to be deemed a hobby now versus a business. Now, what's the difference? A business is something where you try to make money. Right. A hobby is where you don't really try to make money. You're just doing it for fun. And if you go into a business saying, I'm going in because I want to get losses immediately, and that's going to benefit me immediately from the tax benefit, you're telling IRS, I'm not really into this to make money. And you may be deemed a hobby. If you're a hobby, all your deductions get disallowed, get your tax on all your income. That's a really bad deal. So that is why I don't recommend adjusting withholding. You can do it later on in the year if you start saying, I have some losses this year. It's going to exceed my standard deduction, or even it doesn't exceed the standard deduction. I'm going to have some losses. So then you can meet with your accountant and adjust the withholding for the rest of the year. You can do that. But I would not say that I'm going into a business in order to first get some of the tax benefits. That's something IRS would not like, and you're basically telling the IRS, I'm really into this as a hobby and not into this as to make money as a business. So that's something I would never say or do.
Awesome. I'm glad you cleared that up because, like I said, I hear a lot of approaches that way. Just go ahead and adjust your W-4s right away. But, like you said, toward the middle to the end, because it makes more sense versus just going straight into it saying, I'm going to adjust it right now.
And that only if you think you're really going to have losses, if the pro forma show that. People should go, there's a lot of benefits to going into a home-based business. Let me be frank with you. As I said, we have two tax systems. And if you can have a successful home-based business, you can make a lot of side income. The new tax law provides where up to 20% of that income may be tax-free. You can basically exclude 20% of your income from tax, which is not true as an employee. You can write off part of your house, your spouse, the equivalent of your kids' education and weddings. You can set up a pension plan that makes any government plan look small by comparison. I mean, the benefits, you have time freedom. The benefits of a home-based business are enormous. But I wouldn't focus on the loss part of it. I wouldn't focus on the fact that, you'll get some tax deductions. That shouldn't be your primary focus.
Awesome. Could you please expound on the pension plan part you just mentioned?
Well, most people set money into an IRA where you can put away like $5,500 a year. But if you're a small business person, you can put away a lot more. You have a lot of different pension plans available. You can put away into a SEP up to $55,000 a year. You can put away into a sole owner 401k, which you can put away $55,000, which part of it can be tax deductible and part of it can make tax free for the rest of your life. And if you really make a lot of money, you can put away in a defined benefit plan. And I have a big discussion on this in my 7 Secrets of Wealth, as my book, Lower Your Taxes Big Time. You can put away as much as $220,000 a year. Hey, you want to take a hit on taxes? Put away $220,000 into a pension plan. See how that does. So, there's lots of pension and profit sharing opportunities available for small business that the average non-small business person just doesn't get.
Awesome. I thank you very much for clearing that up because, like I said, once again, when you look on YouTube, a lot of these different companies always highlight, hey, you can write off this, you can write off that, write this off, write that off, and at the end of the day, they're just looking at it through a tiny microscope.
I think that's true. But I'm saying there's so many benefits to having a home-based business. The tax benefits are certainly one of them. I'm not going to deny that. Hey, I'm a tax lawyer. I can attribute to that. But there are many other business benefits to home-based business that people should be looking for, and they should actually take precedence.
Awesome. Okay. As it relates to the 7 steps, the book that you just mentioned. As a matter of fact, we have it right now for shipping. You just pay the shipping costs on it at $6.95. How much value do you feel that brings?
The average reader will generate somewhere around $8,000 to $10,000 in new deductions. Not bad for $6. Not investment. That's the best deal in town. And all they're paying for is the shipping. And basically we cover the top 7 most overlooked and most significant business deductions for small business. And that's why we wrote it. We wanted to hit the real top. And we not only cover them, but we show you how to bulletproof your record so you have that peace of mind of not having to worry about an IRS audit again based on those deductions. What's that worth?
Wow, that's awesome. And as it relates to QuickBooks and different competitors, I first was introduced to your company through a company called Wake Up Now, and that's Taxbot. And so after Taxbot, I was like, this is awesome. This is just phenomenal to stay in order. And the fact that an IRS specialist was over spearheading it just made a lot of sense. So it seems like there's a lot of copycats now. What would you say that is unique about Taxbot out of your mouth?
Well, first of all, QuickBooks is not a competitor for Taxbot. QuickBooks is an accounting software program. Accounting software is very different than expense tracking software. And they'll tell you the same thing. Accounting software, for example, will never ask you, who did you have lunch with? What was the business reason for the lunch? It doesn't happen in accounting software. It's not compliant from a tax perspective. What's interesting is that a good tax tracker like Taxbot can replace QuickBooks, but QuickBooks cannot replace a good tax tracker. Kind of a little dirty secret in the industry. And now, what set Taxbot ahead of everybody else is that there's a number of things. First of all, Taxbot, we have a patent pending technology where we will read receipts, and we will actually try to take that information and put it in the right categories for who, what, when, where, and why. We're one of the few companies that really do that. We actually give you a map of your location, which is attached to your auto mileage. It is probably the easiest tax expense and mileage tracking program out there to use. I designed Taxbot for me. One thing I've learned, if it's simple, easy, and fast, I'll do it. If it's not, I won't. And so Taxbot has 3 buttons: income, expense, and mileage. That's it. And the mileage is automatic, basically. And some of the other stuff is automatic. So it's probably the easiest thing to use. It is certainly the most compliant. Many of these other people are not necessarily compliant. They say they look good, but they're not. For example, there's a major mileage tracker out there which doesn't specifically ask all the time the explanation for the trip. If you don't give the explanation for the trip, you're not compliant. And if it doesn't ask for it, guess what? You're not compliant. We are very compliant in Taxbot. And then another thing that we have a whole bunch of reasons why Taxbot's better, but one big thing is we're one of the few software applications where you get real customer support. You get real people that you can contact in Salt Lake City. They're available there, anytime you want to call them, and they will answer questions. They'll walk you through things. And it may not sound important to you, but software has issues. You come up with an update with an iOS or a Droid update, all of a sudden the software doesn't work. Or you have crazy problems with your other application, somehow has conflict with something else. So having customer service, a real person who speaks English, who can answer, and I think there's somebody that speaks Spanish too, that can answer your questions, is really very important, because you never know when these things happen. And things do happen. And you get real customer service here in the United States. So there's lots of reasons why Taxbot's better than its predecessors. And we don't charge you for the new updates. We have updates, which we do all the time. It's part of the price. That's built into the renewal. So we do that, and that's the way it is. That part's free.
Awesome.
And by the way, one more thing. You also get 15 months for the 12 months. So where a lot of other people give you 1 year, we give 15 months.
15 months. Wow. Well, I'm going to tell you something, Mr. Botkin. You really summed up a lot of the questions that I have. And I feel like, do you have any more information that you would like to share with me?
Well, I do want to mention one final thing, is that Taxbot works on multiple devices. I don't know if you picked it up from the webinar, but it works on multiple devices and multiple businesses simultaneously. So if you've got a business and your spouse has a business, maybe your kids have a business, each of you can use Taxbot. Each of you can get separate reports on one account. You don't need separate accounts. And it also works on multiple devices. Like my wife is a Droid user. I'm an Apple user. We will never switch. I'll tell you that right now. I'm never going to switch from Apple.
I understand that.
And we can each use Taxbot on our own separate devices. We don't have to have the same devices. That's another big thing about Taxbot. With the improved tax law, IRS is really going to start scrutinizing small business more and more. Having the right records now is more important than ever. If you don't want to use Taxbot, you want to get a fireproof safe and use something else, fine. But do something is the bottom line. Do something. If you want something simple, easy, and quick and compliant, you're not going to get better than Taxbot, especially since it comes with a guarantee. And I will promise you, Ellery, that it's going to make you and everybody listening to this make all of their lives a lot less taxing.
Yes, sir. Yes, sir. And that's exactly what we do not need. A more taxing life with the stresses. Stresses of life anyway.
Well said.
Well, listen, I most definitely thank you for your time and your the information that you just gave. And, it just makes sense. Like I said, what I like to push is the benefits of having a home-based business. And I'm glad that from the question that I asked, we were able to actually expound on major benefits that everyone should look at other than just the tax side, other than just the, hey, change your W-4s, or hey, just think about all the write-offs that you have. Hey, let's make money with these different home-based
Absolutely. If you make money, believe me, the tax benefits will accrue to you. It will come. But the key is to focus on making money. That's got to be your key, and proper record keeping. You also want to make sure you keep the money that you're making.
Right. And obviously, with a home-based business, it's convenient. So you just come up with a strategy, you stick to it. It's not a set time or extra pressure, like a regular job.
That's right.
You just, position yourself in a better situation for savings, for lifestyle changes, all those great things in one. But the key is to be knowledgeable about the benefits and to be knowledgeable about is that what you went over just a minute ago.
Absolutely.
Those are pivotal.
You got to understand your business, know about the tax benefits of your business, and implement it. You do that, as I said, you'll make your life in many ways less taxing.
All right. So, as an overview, if you want to give yourself an instant pay raise, you might want to reconsider that. You might want to wait until mid to the end of the year to be able to actually say, okay, I have these losses. But in the meanwhile, what you can do is try to make profit. Take your time, focus on your business, and become profitable, which will help you generate business income right away. And then you also would generate a passive residual income. And these are the things to help you turbocharge your financial situation, not to mention income shifting. So, guys, let's not procrastinate. Click the link below and take control of your economic future. Stay connected with us by subscribing to our YouTube channel and Facebook page below for step-by-step winning strategies on game-changing companies that often offer proven home-based business opportunities. And once again, Mr. Botkin, I want to thank you for your time.
It's my pleasure.